Hello everyone, today we are diving into three major Canadian real estate stories for the last week of August. First up, Manitobans are making the rest of Canada jealous. You won't believe how much money they're saving compared to everyone else. Then Canadian mortgage debt is growing at its fastest pace since mid-2023, but economists say we are still operating at near recession levels. What does this mean for homeowners and the housing market? And finally, Canadian consumer spending took a hit in July, with retail sales falling 0.8%. Is this a sign that Canadians are tightening their belts or just a temporary blip? Let's break it all down. Here is some genuinely good news in Canada's debt crisis. Manitoba leads the country with the lowest consumer debt per person. We're talking about credit cards, car loans, personal loans, everything except mortgages. As of Q2 2025, the average Manitoban owes $18,487 in non-mortgage debt. That is $3,660 less than the national average of $22,147. Compare that to Newfoundland and Labrador, where residents carry over $25,000 each in consumer debt. But here is the reality check. Even with lower debt loads, financial stress is hitting everywhere. 1.4 million Canadians missed credit payments in Q2 of 2025 alone. That's 118,000 more than last year. The most telling stat, Canadians without mortgages are nearly twice as likely to miss payments compared to homeowners. The bottom line, Manitoba's lower debt levels are definitely worth celebrating, but they're not a shield against the financial pressure that rising rates and inflation are creating nationwide. Even the most debt-conscious province isn't immune to Canada's affordability. Let's talk mortgages, because this story is wild. The outstanding mortgage balance in June 2025 was 4.74% higher than last year. That is a massive $103.8 billion increase. This is the strongest year-over-year growth we've seen since mid-2023. Now here's where it gets interesting. Economists are saying this growth is still happening at near recession levels. What does that mean? Essentially, while mortgage debt is growing, the pace of that growth is still much slower than what we'd see in a healthy, booming economy. The annual growth rate appears to have encountered some friction at this level, but it's remained roughly the same since March. This suggests we might be hitting a ceiling. People are still taking on mortgage debt, but they're being much more cautious than they were in previous years. With mortgage rates remaining above 4% and more than a third of mortgages set to renew by the end of 2026, many at significantly higher rates, we're looking at what experts call a ticking affordability time bomb for many households. This isn't just about new buyers. Existing homeowners are going to face the same serious sticker shock when their low-rate mortgages come up for renewal in the next couple of years. And lastly, let's talk about what's actually happening with Canadian shoppers right now, and it's not good news. Here's what went down in July. Retail sales dropped 0.8% according to Stats Canada's early numbers. Now, that might not sound like much, but here's the thing. This came right after a solid 1.5% jump in June. So we're seeing some serious back and forth action here. But zoom out and the picture gets clearer. The second quarter only grew by 0.4%. That's down from 1.1% in the first quarter. In fact, Q2 was the weakest we've seen since mid-2024. Translation, Canadian consumers are getting more cautious, and you can probably guess why. Tariff fears and slower immigration are creating uncertainty everywhere. Now, June wasn't all bad. We saw growth across the board: food, drinks, clothing, with 6 out of 10 provinces posting increases. Take out car sales and things looked even better at 1.9% growth. So there were definitely some bright spots. Here's why this matters for your wallet. Even though the Bank of Canada has been cutting rates, they're still sitting at a higher level than they have been. Canadians are still pulling back on spending, And get this, 27% of retailers say they're already feeling the pinch from tariffs, dealing with higher prices, weaker demand, and supply chain headaches. The bottom line is Canadian consumers are playing it safe right now, and the numbers prove it. Even with cheaper borrowing costs, people are thinking twice before opening their wallets. I hope you enjoyed these Canadian real estate stories. If you want to stay up to date with the national real estate market, please like and subscribe to this video. If you enjoyed this video, you're going to love this one as well.